mics here, and then it should be working. I believe we have around three people currently involved, so that's great. I guess we'll wait here for about 10 seconds or so, and then you can go and ahead and introduce yourself. I'm just going to check make sure everything's running. Go ahead. Yep, it's all running up. So welcome guys. This is the after hours unofficial podcast that I'm running called Talking Stocks. And today I am joined by Retentive here, and I will have that linked on after hours as well. Uh, Obviously, I'm Day Zero, so nice to put a face behind a name sometimes. But yeah, you can go ahead and tell us about yourself.
Yeah, hi. I'm Nathan. I've been doing this for oh gosh, many years, probably a little more than a decade now. And as a kid, this was what I was raised on. And as a hobbyist trader, I've been moderately successful. I'd say the last couple of years have been outliers for sure, with very strong performance in the high risk portfolio. But the biggest thing, like my brand on After Hour especially, has become the risk guy, which is mixed. But like, no one's excited about the risk management guy. But I can tell you, like, the big thing right now, especially, but all the time, the big thing about all this stuff is if you're a retail investor, you are not as smart as most of the market, and you have to be a defensive buyer, right? You have to think really hard about what you're doing. So, yeah, that's hoping we'll get to talk a little bit about that stuff, answer your questions, see where things go.
Perfect. So starting off here, a big we will get into viewer questions as well. So if anyone in the chat has a question, that's a big goal of ours is to make sure we get to those as often as possible. So if you do have any questions while we're discussing, we don't mind jumping off topic or bringing in your discussion as well. So keep that in mind that you do have a voice in this podcast as well. Um, Especially with the scale currently. As it scales up a little bit, that might be more of a, pre podcast thing, but we definitely at the current scale of 200 people or less at a time, that's manageable at that point. Um, the first thing I want to get into is penny stocks. So this has been a huge thing on After Hour. I know I'm kind of jumping in heavy, right? But obviously, like if you've been around After Hours since its inception or just over the last couple of months, it was originally a lot more. It was also a lot smaller community at the time, so that's something to keep in mind. Um, is a lot of the accounts that were posting, a lot of the ones you were following, were accounts with 100,000, 200,000, $1 million, right? But now as we're getting more and more users on there, you see penny stock discussions, accounts with 22,000 or less, um, posting about, oh, the next giant stock that's going to jump, right? And it might have already ran 40, 50%, but its market cap's like $90 million, right? So it's really easy to manipulate. And there's kind of like a hype slash like frenzy around them right now. Like everyone, I believe, I don't know if you guys are following X52 or you're following atypically. That's all I'm going to say. Typically, if you're following either of those users, there's this giant hype like, oh wow, they made a lot of money, and atypically definitely has some kind of screeners or something he uses. I don't know his exact methods, but it does seem like he is a little bit more fact-based with his investments. Like he's finding something online or he's figuring something out before it happens. I mean, that's pretty obvious with how much money he's made, and he's been right with I think it's like 20 out of 20 stocks so far. And he can always be wrong once and lose a lot of money, so don't get me wrong there, but uh, X52 as well, was like he made a lot of money in a short amount of time, but he also lost lot of money really fast. And his weren't off penny stocks; his were off of just like out of the money options trading. So uh, I guess my point here is that a lot more risk has been prevalent in the community recently, rather than theta options or responsible options trading that had been previously done. And it's also seemingly influencing some of the larger, um, I guess the word wouldn't be creators, but the larger posters on After Hour, the larger portfolios on After Hour. A lot of them have been doing riskier and riskier strategies. As I think they've been influenced by not only, I think MicroStrategy is probably what originally got people to lose a lot of their risk tolerance is that large drop in such a short amount of time and that large gain in such a short amount of time. People that were exposed to that, I think, had some kind of cultural effect. I don't know if that's in the broad market or just after hour, but I feel like it changed a lot of ways people view their risk for their portfolios.
Yeah.
I'll let you go ahead and jump in here. I've been rambling.
So there are a bunch of different elements to this, I think. One, we'll talk about atypically in here in a second because looking at that portfolio over time, and I've been looking at it for quite a long time. I think it's obviously the last 2 or 3 weeks speak for themselves in that this is a person who was in the right place at the right time to capture a big sort of bubble. And it is absolutely a bubble what's happening in quantum right now because quantum, which could be a tremendously valuable thing soon, is basically worthless nominally right now, right? So this is an entirely speculative event, and that's fine. But a lot of atypically there's also been writing that, and then there's been a lot of other things that have been like things that were beat to hell and then came back huge. And the comeback has often been inexplicable. So yeah, I completely agree that this is probably a screener based strategy, and we'll talk a little bit about what that strategy might have looked like in a bit. But yeah, so I think the thing that I've noticed as well is that in the community, it's not just on After Hour, it's also on Reddit, it's also on X, Twitter. It's clearly expanding way beyond just this area, but like any sort of place where retail people are talking to each other, the risk appetite has skyrocketed, and I think there are a few reasons for this. Um, One of them is that I think that until somewhat recently, we were sort of in a situation where over a period of a year, maybe you might have, five, six, seven major big deal, like someone has, $20,000 and goes to 5 million in their account and posts about it on Reddit or whatever. I think I've seen five, six of those in the last month, and in the last couple months for sure. And it's been a combination of things. I think a lot of this is sourceable back to like a tremendous risk appetite trend that was happening earlier too, but um, in general, people are becoming much more open about posting that kind of thing, which is creating a result where everyone thinks they can achieve that, and your risk appetite's enormous when you think that you can make gains, and you're only really getting exposed to the gains. So there's that element. I also think the other thing that's happening is the market's tightening, and this is a huge deal, I think. So when Nvidia was going up 2% a week, pretty consistently, nobody cared about all these penny stocks at all, right? Everyone was just like, I don't have to do anything. I just put money in Nvidia and it just keeps going up, or I just put money in this thing or that thing, with one sort of exception. We'll talk about this because there are some stocks that, by sort of the simple definition of what a penny stock often is, there's some stocks that became big runners this year that were categorized as penny stocks at the beginning of the year. But for the most part, I think what we've seen has been that as the market has tightened and as these big success story stocks this year have started to correct and behave normally, people have grown a gambling appetite. And this has gone into a direction where like high volatility is really the thing, So that's a lot of what I think is happening here. It's very interesting to sort of take note of because what this suggests is that we're entering a period of really constrained trading where probably we're going to be working within a channel for a long time. Now, of course, when the political climate changes, this could all go out the window. Who knows? But I think that's what happened with MicroStrategy. Is they're in gambling appetite, so it blew up. I think that's what's happening with a lot of these penny stocks. Gambling appetite blows up. So the real question here is, how can you satisfy your appetite a little bit without getting in serious, serious trouble? Because when I look around right now, mostly I see opportunities for trouble.
I definitely think the same thing. So we had really good success stories, like you said, NVIDIA, Palantir, even Apple and Google, I believe, like have over outperformed what they have. I think Microsoft's lagging comparatively in the Mag 7, but um, all these companies are used to seeing like just continuously going up have kind of leveled out as the year ends, I believe. Especially Palantir. I mean, Palantir, it shot up ridiculous. Uh, but I mean, right now it's like, okay, who's gonna partner with Palantir? That's what people are looking at. So where it had previously been, oh, Palantir's gonna keep going up, keep going up. Now it's okay, who's the next Palantir? Who's gonna partner with Palantir? Who's like, it's kind of shifted. A lot of the market sentiment there has shifted from the actual companies, like especially within the after hour community, right? It's like, okay, who's partnering with Nvidia? With even with KULR, cooler. Um they posted that Turkey Day post where it was, oh, we're partnering soon or whatever. And everyone was like, okay, who are they partnering with? And they said like Nvidia, Tesla, people were hoping it was going to be this giant thing. And then I think it was either yesterday or the day before they announced their contract, and it was with the U.S. Army, which dropped the stock price down significantly. But because, all that anticipation, we kind of had alpha there because obviously Alloy over on the Discord for After Hour, the official Discord, the free one. Don't get scammed. Don't join some random Discord um, that you have to pay for. Don't do that. But he interviewed the CEO for Cooler, and obviously I also streamed it here, and it's still posted on my channel. But that CEO had told us in that interview, towards the end of the interview, oh yeah, that was one of our social media people. He had a little bit too much to drink, and um, pretty much it was a nothing burger. So I didn't, at the time, we didn't know if that was just an NDA issue. Like, okay, he can't talk about it because he's not supposed to talk about it yet. Which with the army, that makes sense, right? Like, that was confidential until they announced the contract. Um, or it was just him being truthful and it's a nothing burger. It turns out it was kind of both in that sense. So that was pretty interesting. Um, which brings me into another concept. What do you think about the potential for after hours to end up being a place for CEOs or companies to have social media accounts?
Yeah, it's an interesting point. One of the things I've spent a lot of time looking at lately has been investor relations pages and announcements and things like that. Um, I It's interesting. So the cooler folks have been very open about embracing retail and retail enthusiasm. This is not true for all of these companies, right? Like there are a lot of companies that have been in this category who see their stock price suddenly skyrocketing and cannot explain it and panic and just want to sort of disassociate with what's happening. Um, that is an interesting challenge, and it's going to be an interesting sort of conflict. I don't know. We'll have to see. We'll have to see what happens. Um, but uh, yeah, I mean, there's certainly opportunities there that would be very interesting to see. Yeah. So shall we get into some specifics? Should we look at some stuff? Talk through.
So we can jump to the chat real quick because I did see
Yeah.
there was a couple people. A lot of them were just saying good morning, what's up? Oh, I like rocks. Jumped in. Hey, buddy. Good morning. And then someone mentioned a ticker MFA. So if you want to jump into that, you can while I'm reading the rest of these. They said that has a book value of $18.42, which pays a 35-cent dividend each quarter, which under 10.50 is a steal to buy with upgrades to $12 or higher. So yeah, MFA, Mike, Foxtrot Alpha.
REIT business makes sense. I haven't investigated this company a lot, so I can't speak to them very
What company
usefully
is it
immediately.
and what
MFA
sector?
Financial.
Oh,
They're a
financial.
REIT.
Okay.
It looks like, yeah. Um, Obviously, whenever you see stats like that that look pretty good on paper, my first question is, what happened?
Right.
And this is the thing. This is the thing that I want to drive home all day today. Basically, is like what happened, because there's always a reason that something happened. And sometimes it's great, right? Sometimes it's great to get in when something happened. You're like, it's not that big a deal. But sometimes the reason is massive. And it's like lurking behind the scenes because you don't see it immediately in the at a glance stuff that you see on Robinhood or E-Trade or Yahoo or whatever. You got to go read the filings and you go, oh, okay, I see what's going on here. Yeah. I don't know a lot about know a lot about these. I'm REITs are not a market that I'm particularly familiar with, um so I would have to explore that more before I had useful commentary on it. But yeah, it's an interesting thing when there's these differentials a lot.
So someone came up with a point, diversification with a strong focus on growth sectors, EV, AI, pharma, defense, quantum is key. And that's why Cooler kind of jumped up so fast. Um, and I would also say um, a lot of these drone parts companies are also trying to jump into the same thing. I don't know if that's gonna work, but a lot of drone part companies are also looking to expand into other revenues of business. Um, because the drone industry is jumping up, so they're getting all this extra funding. So then they're, trying to then diversify that. So that's another thing I've been kind of eyeing, as well as this isn't really diversification, but diversification on my end. I've been looking into a lot of different who sells the shovels type scenario, like for quantum tech, right? I was looking at, okay, so who's cooling these computers? Which I jumped into it, and all I could find was that they have to be like at a very specific temperature. I'm sure Google has their own like stuff they own, but when I looked it up, there was like cryogenic cooling for quantum computing. So that was a pretty interesting thing. So like just doing your own research, and uh, even if companies aren't diversified, you can diversify between different companies. So that's another good point there. Diversification is definitely important, but for certain companies, that's not too smart, if that makes sense. Um, for a company like Cooler that sells like cooling technology and stuff like that, it's really important because like you get NASA on your books, you get an eVTOL company on your books, you get a quantum computing company on your books, you get all the drone companies, and then the Army and the Air Force and the Navy. So that's important for companies like that, but for other companies, you could see that as why are they doing that? Because sometimes with companies, you kind of want them to be a one-trick pony, right? You don't want them to
Especially
start spending
with
money
small caps.
everywhere, especially
So
small
so like
caps.
when you're a small company, it's difficult to focus. It really is. And one of the things that I've seen get a lot of sort of growing companies in danger is when they get distracted, and sort of have shiny object syndrome and start chasing after a lot of different things. Usually, companies get over this while they're private, but not always, especially not these days. The other thing I want to point out is like when you're talking about portfolio diversity, if you are putting yourself in all these high growth sectors, the ones that we listed out before were like I can't even find them that list anymore. EV, AI, pharma, defense. Okay, so of those though, three are really predicated on the same thing, which is interest rates going way down, right? And this is actually going to be true pretty much across the board for growth investing, like strong, you know, high pressure growth investing is going to rely a lot on availability of capital. So, in a market where we feel a squeeze suddenly on the available liquidity, and everyone is just getting tight-fisted and not being able to give out loans, if people aren't willing to spend money on discretionary items, all of these things, you suddenly wind up in a situation where these sectors that are a little more flexible or a little more growthy because they just don't have established needs are danger zones, right? And you can look back on historically what's happened in some of these sectors during tough time periods. Pharma less so. Pharma is just generally high risk because in pharma, of course, if you're betting on small companies, if you're betting on big companies, a couple of trials. It just takes a couple of dud clinical trials to doom that stock. A lot of people experience this even with like Novo Nordisk and things like that, where these are massive companies and they still struggle with that. So, you got to keep an eye on the risk and where the risk is coming from, and make sure that when you've abstracted out what your portfolio is, it's not really just exposed to one thing still, right? Because it can be very, very easy to do that by mistake. Especially with something, another example of this is Bitcoin, right? If you say I'm pretty bullish on Bitcoin, let me buy a little MicroStrategy here, a little Semler there, a little ETH, why not? Because that's good. A little Robinhood, a little Coinbase, all of this is really just bolted to the price of Bitcoin, right? Um, so if you create a portfolio like that, it's going to look like a mixed portfolio, but in truth, it's really just trailing one asset. And you got to be careful because that's a good way to zonk yourself and not even realize until it's too late that you had a portfolio set up that way.
Zonk. That's funny. Yeah, definitely. Because like you were saying, like diversification is really good, but when you're kind of just all over the place, it's not. So that's kind of because then you're just spending a lot of that's just leakage going to all these different projects while your main source of income is what's still going up and down and trailing the stock price, but you're losing a little bit of that with the leakage. So like you'll have lower highs, lower lows. So yeah, definitely. And then they'll end up diluting in order to get more funds, likely below market price, and then especially on these smaller caps. So
Yeah. So
yeah,
let's
you
talk
don't want
about
to
that
get caught in
actually.
that.
Let's talk about some of the things that you can run into with a small cap, things that you should watch out for when you're looking at them and analyzing what's happening. So I wrote a little checklist on After Hour, and we can just talk through some of this stuff. Um, let me see if I can pull this up here. This is just sort of a starting point to start thinking about as you're analyzing stocks that people pick out for you, and you wonder, are these as good as they seem? Are they too good to be true? Um, Let me see if I can find it. Uh, okay, lots of people talking. Lots of people talking. Um,
Hmm. While you're doing that, so what does your company trade under? Okay, so that's like a actual. They're mentioning some tickers, but like
yeah,
we'll jump into that after that. That might sidetrack a little bit too much.
yeah. That's the one area that I'm gonna have trouble with because I don't like talking about anything unless I've really thoroughly researched it.
Right, and to just
Um,
kind of look at a overall
right.
chart, it doesn't really tell you anything.
All right. So yeah, let's just talk through. Okay, so let's just talk through a couple of these. So the first thing that you want to do when you're looking at any stock basically is you need to ask a couple questions. So these are the basics that you're always asking. What is the company? What industry are they in? Are they making money? What's their P/E like? Is their P/E aligned with industry expectations? If it's not, why not? Right? This stuff is always stuff that you just want to think about as you're getting into a stock for the first time. Um, uh, then the next thing you want to think about, for me at least, is okay, where is the growth of this thing headed? Why do I want to buy into it? And what's the time frame that I expect this to happen in? Right? Because you want to have the mindset as you're buying this thing of like, yeah, I'm buying it for what it is today and all the risks I'm taking on today, but I'm also buying it for what I think it will become. And I want to make sure that when I compute out how I'm buying this thing, that it actually is going to meet the levels I need it to meet in order to succeed in my portfolio. So think that through. Think through how likely that is to you and what the size of the bet you're willing to make on that likelihood is. Um, Also think though about what the downside is. What's the worst case scenario? How is this going to go wrong for you? Um, and I think another very valuable thing to think about as you're doing this is like the kind of buyers that are currently involved in the company, and the kind of buyers you expect to be involved in the future. This is all stuff that I would always consider as I'm going through. There's some great videos out there from people who will walk you through how to do some initial validation of an idea, make sure everything's good. But when you're talking about a smaller company, not a company in the S&P or whatever, the company that we're talking about, less than a billion market cap, way less sometimes. A penny stock typically defined as about like less than $5 a share. Especially something like that because there's all sorts of increased risk and volatility when shares are that easy to get.
Do you mind if I jump in
Um,
right there real quick?
yeah,
So there can be two completely different companies, right? This one's $5, this one's $5. That has no indication of their market cap. This company could have $5 a share and be a $20 million company. This company could be a $22 billion company. So
this
there's
is true.
you do need to look at
However,
market cap as well.
right, and you need to look at market cap. Market cap's very important, but you also need to consider that both of these factors play into the volatility of the share price. And it's less true now because fractional share ownership is a thing more across the board at more brokerages. But in general, people aren't buying fractional shares, um, at least not at high scale. And in general, the other thing to consider is that if this is a stock on which options are being traded, those are 100 share contracts, right? And those contracts will vary a lot in sort of granularity depending on the share price. So if you have a $5 share price, chances are you got a 450, a $4, a 550, a $6, these are the kinds of strikes you're talking about. Whereas if the stock price is 10 times that, you have a $50, a 51, a 52, a 53, right? And you've got often 50-cent. This is a huge gamut compared to this other thing, which means that the volatility and the jumpiness of all the associated derivatives and of the underlying are going to be affected by that. So in general, just keep in mind that the smaller a stock price, the more volatile it's going to feel, and that you have to watch out for that. Especially because the reason we just talked about. The other thing to consider is that a lot of companies, they've over time tried to keep their stock price around, tens of dollars, 100, something like that. That's often very convenient for people to trade. That's often what people like to keep their stocks at, which means if you look back on the chart, that $5 stock had a 95% loss. So, this is stuff that you want to consider, and this is why one of the many reasons why penny stocks have such a reputation. There are other reasons as well. But a lot of times the big thing is there's an illusion when you're buying into something that has a small share price that it's not as big a risk. That's only true if you're buying only a couple shares.
And there has been kind of a movement towards keeping your company private if you're still actively wanting to manage the company. Um, kind of, I mean, I'm not going to say it was a trend started with Elon Musk and like SpaceX, but definitely there's a lot more companies looking to stay private in order to avoid that jumpiness in share price. Because if your valuation's at $10, it kind of sucks as a company, right? Unless you're just trying to cash out your shares at some point. But keeping your company private and just taking private funding has been a larger move recently, especially with newer technology like the Helium-3 as well as the GR. I think it's 820. There's a lot of you can correct me if I'm wrong on that, but there's all these different materials and I kind of want to jump into that. I'll look up the actual name of that so I'm not misleading people. Um, I'll jump into that later with that specific alloy, but
Yeah. So I think that you're sort of leading into an interesting area here when you're talking about materials, though, because that's a sector that we can talk about for quite a while. It's actually a very common penny stock sector. Um, But let's just go into some penny stock specifics before we get too much further. And this is not just penny stocks, this is small caps as well. Usually these go hand in hand. They often don't. Whatever, these things can change. But in general, if you see a company that's smaller, much smaller, 100 million, 200 million, 300 million, I start to get worried. Whenever I see something that size, I have to think really hard about what I'm doing. Um, and we know that there are companies that have market caps way smaller than that are trendy right now. So you got to watch out. Um, some other questions that you should start asking yourself as you start investigating what's going on. Did this company go bankrupt? Like, when did they go bankrupt and why did they go bankrupt? And I know that's a silly question. And the thing is, if a company went bankrupt, that's not actually a bad thing necessarily. Often it's good if they just reorganize their debt and they now are able to service it and you as a customer or as an investor are able to get in at this point, your risk has been reduced and the share price has been beaten down a lot. And maybe they've leaned up to just the parts of their business that are the core of what they intend to do, and they're very hungry. This can be
Also,
a
it's
great
very
trade.
indicative that their books are no longer cooked. Like a lot of companies, cook their books. So
It is
as we
very
saw
hard to
with
get through a
as we saw with
bankruptcy
a very
administration.
large company recently that got delisted from the Nasdaq 100. I believe it
Yeah.
was Supermicro Computer.
Supermicro's been fighting a lot of things over time. I think they didn't get delisted in the end, but it was close. Um, so, but like, yeah, that's a thing. That's a thing
Oh,
absolutely as well.
sh
Is that like bankruptcy administration is hard to get through without being honest. You've got a judge over your shoulder. You've got an external administrator watching the company. Um, there are some notable examples where that hasn't been true. And you keep an eye on those. But for generally speaking, if a company has just exited bankruptcy, they're going to be in a healthier state in terms of their books. Does that mean they are a healthy company? Not, because the next question you have to ask is, how did they get there?
right.
What did they get rid of in order to make this possible? So there are companies that have exited bankruptcy, and it was a Chapter 11, so this company still exists. But in order to exit, they sold all of their IP, and now they're just a couple people in an office somewhere with nothing. And uh, this is not what you want to invest in, right? At that point, if you're trading this thing and this price is shooting up and down, you are just gambling and trading against other retail traders who are guessing what's going to happen next. Um, uh, so you got to be very careful of this, right? Like, this happens all the time, by the way. I don't know if you remember, but Lime Scooters was a company that was publicly traded for a long time and didn't own anything. This stuff can happen, right? So keep an eye out. Be very careful, and make sure you're reading up on what actually happened to the company in the end and what pieces of the company still exist with it.
Are you
Um,
are you familiar with what happened with Celsius as well, or no?
um, which Celsius?
The one that got
Alex
trashed.
Mashinsky Celsius,
Yeah,
or
yeah.
yeah, yeah, yeah. Hey, you want to talk about that?
A little bit. If I'm not as versed in it, but that would be pretty fun to get into.
Yeah, yeah. So these are, of course, very messy situations with some of these companies and organizations that went through horrible things at crypto timeframes. And Celsius was one where there were a lot of different parties fighting for hunks of very little money, and it created a lot of ugliness. So yeah, we can talk through that at some point. There are a couple other very interesting sort of bankruptcy cases that are making their way through the courts right now that are worth keeping your eye on too. Um, the next thing here that I wanted to touch on is um, we discussed delisting for a second. Delisting isn't the end all be all. I mean, it's bad. If you get
Means you're
delisted,
back
it's
to
pretty
over the
bad.
counter. I mean, your stock can
Right,
still likely be traded, but it's
right.
most
It's
likely
a
still
it's
on Fidelity.
right. What I would consider delisting is not a and again, this is all my personal methodology. Your methodology may be different. I'm not a certified financial advisor. This is not my job. I'm a hobbyist. I've been doing this a long time and I'm pretty successful, but it's a hobby. If a company's been delisted, it points to one of a bunch of different things going wrong, right? One is they went through bankruptcy, right? One is their stock price dropped so low the exchange wasn't willing to keep them on. Um, and then the other thing is, of course, allegations of misconduct. And we've seen these in different forms. These are the kinds of things that often lead to a company being delisted. Keep an eye out for that. Keep an eye out for a company being delisted or almost being delisted. Figure out why they weren't. If they weren't, and make sure you're as confident in the reason as whoever else was, deciding this. Because sometimes you look at it and you go, well, I'm glad they figured it out, but did they figure it out? A super micro for me is an example of that, where I'm like, I'm still a little sketched out by this company, and I don't know what's going on with it, and I am not a huge investor in it as a result.
Well,
Um,
they made a statement saying that their books weren't cooked, and then they were saying like their valuation was going to go back up. So then you saw their share price go from its bottom down at like 20 something dollars back up to like $34 in one day. And like as a retail investor, I'm not sure what the current I'm not sure what the current share price is, but like after that jump, I would have been out. I would have been if I was betting on a return of that company, I would have been out right then and there, especially if I was in options, because like you're saying, volatility like that, like it's not going to benefit you in the long run. There's no way.
I had a suspicion that something messy was going to happen with Supermicro on the way down, and I actually bought puts at exactly the right time, and that went really well for me. I got out. I was done. I did not go back in, and I'm happy with that decision.
Yeah, I'm
So
happy with that as well.
um, another thing like these, check that the company is current on their filings. There are companies that drag their feet on this stuff, especially if you're a smaller company. There are a variety of reasons you might. One is that they don't add up. Right? This is a thing that happens. Is that you look at your file, they look at their filings and go, "Oh, something's gone wrong here." There are sort of two broad reasons, right? You could, good faith, have tried to make things work out and it didn't work out, and there are either competency issues on your part or a counterparty's part. Um, if that happened, then maybe your balance sheets don't add up and you're worried about that and you're trying to fix it. Another one is you haven't filed yet because you're trying to figure out how to file it because it's going to be bad news. And the other one is you haven't filed yet because no one's present, right? Like the company's collapsed basically. There's nobody working full time at it anymore. This is a big danger sign. If you see people behind on filings and you can't explain it, even if you can't explain it, make sure you can explain it well, right? So all this stuff, when you're all looking at the the sum total of all of these different aspects of a business, you got to make sure that you are confident that it's a good choice, even though one of these aspects is distressed, because generally a penny stock or a small cap, one of these aspects will be distressed in some way. The last thing I want to touch on, and this is a big one, and it comes in a couple different forms, is the company real? And this is sort of a sketchy area. I don't want to accuse anyone of wrongdoing because it's not automatically wrongdoing if your company's not real in the purest sense. There are a lot of reasons that you might be trading and selling shares and trying to raise capital, but not yet be real. But if you see a company that's pitching itself as we manufacture widgets, right? And they say we manufacture and sell widgets to the widget industry, then you want to be able to see on their balance sheets, you want to be able to see on all these different resources, hey, there's the expense of manufacturing widgets and there's the revenue from selling the widgets. If you can't see
Yeah,
these two things from a company that claims they manufacture and sell something, who's doing the manufacturing and selling? Have they not started yet? What's the deal? Where's the money going? What's happening? Make sure you understand that beforehand, because you do not want to get into the sort of messy business of um, trying to get back out once everyone realizes the company's not doing anything. Now, the other hand, businesses, it takes time to spin up manufacturing. Maybe this business went public very early because they're trying to raise money. That can happen. Maybe it's fine, but you got to watch out for that. Watch out. Make sure you can understand why they're not generating revenue from the primary business that they're in.
definitely. Especially if you don't understand the core business. Like, it says, let's say it's $100 million company that says it's in quantum tech, right? Do you know of a quantum computer that, like, why is that company trading at $100 million if they have quantum technology during the quantum run where most of these companies have already went up 400%? Why are they lagging behind these other companies in market valuation? And that's not just with quantum, right? That's anything like eVTOL. Why is Archer and Joby at this valuation, and then there's these smaller eVTOL companies that are down here? You could see that as an opportunity. Maybe you see them as undervalued, but at the same time, like they could be overvalued. They could say that they're an eVTOL company and then not even have their first, like you were saying, not even have like their first model planned out. So they're not like a real company yet. They're trying to get funding, which isn't negative, but they're in the pre prototype phase. Sorry, that was a lot of
Yeah.
words there, but
Chris Bear, a couple of great comments on this, right? Like this is a classic sort of idiom in this world is, are the cars in the parking lot? right?
Right.
Yeah, right. Like, is the business real? Do they have a real do they have a real location? What is their
Exactly.
real location? Why is it there? Are there cars there? How many people do they employ? Um, if the other one that Chris is mentioning here, absolutely true. If they're not in finance and they're not selling ETFs or something, why are they putting tickers on the front page of their website? What is this the only is their only product their, $20 million market cap? That's sus. So watch out for that kind of thing. The other the other part of this is like when you look at their costs, make sure there's one company. I'm not going to call out who they are. It's a company that's been on a lot of people's sort of eye lines right now as we're hyping things up. Um, uh, is something is that there was a company that I went and looked at their financials and they said our largest expense is $9,000 a month for office space. This is a company that's allegedly in a manufacturing and sales business. Um, what? What? First of all, $9,000 a month for office space, that gets you office for maybe 10, 20 people, right? Like that's not a big office. The other thing is that what
There's
about
a
your manufacturing
manufacturing.
facilities?
Yeah.
What do you own? What about, okay, let's say you're pre-manufacturing. What about your AutoCAD license? Like, are you building anything? Are you designing anything? Are you paying a contractor? Because if these aren't on your books, if your biggest expense is 9,000 a month for office space, what are you actually doing? These are the kind of questions that I would be asking when I read when I read financials, right? You got to gut check yourself every single step of the way and ask what's actually going on here. DD from another person posting about it or whatever, that people hype this stuff up.
Due
They won't do
diligence.
the same. Right, right. They won't truly be doing their due diligence every time because a lot of people do DD that's just about hyping themselves up about something they're already going to spend money on. When
There's
you're
a
spending money on it, you got to do your own and make sure you do it right.
there's somewhat of a thing on After Hour where for some reason some people think like DD means deep dive. Um, but
Okay.
when we're mentioning DD, it's usually going to be due diligence, just so you guys know.
Yeah,
I know not
due
everyone's
diligence.
up on the terms, and sometimes people put deep dive and then jump into stocks. But
Which is fine.
if you see the letters DD, it usually means due diligence. Deep dive just happens to also start with DD. Just thought
Yep.
I'd clear that up for the newer investors so that they don't get tripped up with terms.
And Christopher is absolutely right. It's a confirmation bias issue, right? If you go in and your thesis is this thing's going to be huge because the widget business is going to blow up. I saw 8 widgets on my drive into work this morning, and clearly that means the widget business is going to be huge. Get out of that mindset. Start from the point of view of like I saw 8 widgets on my drive into work this morning. That's interesting. Let's do some basic math and figure out how many widgets that means are actually out there and whether or not this is growing or shrinking and whether or not that's priced in. This is what's really all about is you gotta look at stuff and you gotta look at all of this information, take it as a whole, and then ask, is it priced in? Now, this is an investing strategy. People would call this probably a little value investing oriented, whatever. The truth is that on a long tail, the market's pretty efficient. This stuff winds up working pretty well if you identify minor inefficiencies. There are other approaches. There are other things that you can be doing. A lot of them start to resemble gambling. Um, like the way you consistently make money is you consistently invest in things that track the overall success of a large entity like the United States, or you bet on human ingenuity and innovation in the right sectors, and you see where that takes you. And sometimes you can find an inefficiency and bet on it and make a lot of money in 3 months. I've done a lot of that, but often it's a multi-year thing, and you invest in a company and you watch as it gets sucker punched down to a worse and worse and worse state, and you just have to either have your conviction or you cut your losses and you decide to move on.
Which recently there's been a lot of that, right? So there like since I've opened up my After Hour app about 3 months ago, we've seen industries take off like I'd say at a different pace than usual, right? Last year it was mostly the semiconductors and a couple other different company models, but this year it was like eVTOL, batteries, um we're kind of jumping into graphene taking off again, which I don't know if it's ready for that, but that's a different.
Uh,
discussion.
Matt has a great question. What does priced in actually mean? So uh,
Okay.
this is the classic meme. What is that text? Let me see if I can find it.
Priced in
This is
means the stock price is already valuing that news, if that makes sense. Like it's already combined
right.
into the ticker.
And so we can do a little thought exercise here about this, right? So the general premise when someone says everything is priced in, what they're saying is like this is a reflection of you can look up this concept. It's inside my last time I was on, I recommended a book called A Random Walk on Wall Street. It's in there that it gets discussed a bunch. The general idea is by and large, things are priced what they're worth. And it's not just what they're worth today, it's what you'll get out of them long term when adjusted for the time value of money, right? So you can think of this as if I'm buying 10 shares of a stock that's $1 today, and in a year it's going to be worth $1.05, right? Then if I put that dollar in bonds worth, bonds with a 5% interest rate, if I could get those or whatever, then it should still be a dollar, right? I should be spending the same amount of money, a dollar in both places. Um, that is sort of a basic version of priced in, where you look at these things and you go comparing these different kinds of assets in these different situations and understanding the long-term potential of this thing. If the company is going to be worth $1.05, if they're going to pay you every single shareholder $1.05 at the end of next year and then go out of business, then it should be worth $1 today if you can get a 5% bond for that same time frame, right? And that's generally what we're talking about. But then you got to adjust for, oh, but there's risk, and maybe they won't do it, or maybe they'll be worth $2 next year. All this stuff, and that gets priced in too, right? Um, the general premise is basically everyone wants a deal. Everyone who's working in the market wants a deal, and we're all competing with each other to get the best deal, which means that on the long tail, anything with a sufficiently capitalized market will eventually converge on a price that's a model of all the risk factors involved in that thing and all the potential involved in that thing. Um, Now, part of the problem is like there's a sort of intangible item here, which is an efficient market still prices in hype and delusion. And this is sort of what we're talking about with some of this stuff, right? Where like Google posts one blog post about quantum computing, and the entire quantum computing industry is up 800%. Is that because we've had a breakthrough in quantum computing that brings it to us in 2025? Absolutely not, right? Quantum computing is still going to be a niche, very expensive, very difficult thing for many, many years, probably. What has happened here has been an irrational exuberance related to quantum computing, and that's fine. It's great if you got in, um, but that doesn't necessarily mean that what's priced in today is the imminent success of quantum computing. Same thing with things like graphene that we were talking about, right? It's like if you're betting on graphene right now and you think that you're going to get a three bagger in the next couple months, maybe. But if you do, it's going to be because of a similar hype cycle. It's not going to be because suddenly graphene's in everything, especially in an industry like that where we're talking about resources and manufacturing. It's going to take years to ramp up.
Definitely. If you're expecting a major hype boost to an industry, that's a lot different than expecting a catalyst that's going to change the world forever, right? So that's definitely a large change there.
Yeah. Uh, let's see here. Yeah. What else? What else? Anyone else got some other questions, some other things they want to talk about? I mean, we can go on about this stuff forever, but um, largely, I just what I'm most interested in helping people do is grow their gut, because this is where you will make money. Is when you have a gut and you understand how the market's operating and when things are priced in, when they're not, and when the price is not moving the way you think it should, and how you can sort of account for that. Um, yeah, really work on growing those skills more than anything else. It's not, there are people out there who are going to teach you how to use technicals or whatever, and technicals are great if you're trying to decide when to execute or how to execute. But I use them to start me on a journey. I don't use them as an endpoint. Um, there are a lot of studies on day trading and on using technicals and on chart analysis and stuff like that that show that it's one of the only hobbies where the more you practice, the worse you get.
Yeah, that's just
So,
so
uh,
the thing with investing, right? It's a lot different than trading. So a lot of people just see it all as like a broad umbrella, right? But there is differences here. As I've mentioned multiple times, I think even in our last conversation. Um, so if you bought Apple when it was $3 a share, sold it for $3.30, bought it back at $2, sold it at $2.31, and then you were waiting for it to drop back below $2, that would have never happened. So trading is a good way to make a lot of short-term money if you're good at it or if you get lucky. Even when you're good at it, sometimes you don't get lucky, right? And then you'll miss a catalyst event if you're out of the market at that time, or you have, let's say, puts, right, in the options world to where it's not going to get back down there. And just investing, you believe in the core business, so you buy shares, like with Apple, Microsoft, at the end of the day, like it's easier to say it now because it's already happened, but like Facebook, no one saw that completely annihilating MySpace. No one thought Blockbuster was going to go out of business. No one thought Toys R Us was going to go out of business. Like decades before it happened, right? So, um, or years before it happened. In social media life, that's about a decade. You know what I mean? Everything's kind of goes fast, but um, there's a lot of difference between investing and trading, and that's trading is trading very short term usually, and then investing is buying and long holding uh, to get generational wealth usually, or to get retirement money. So or to buy your first house 10 years later. So investing is usually a lot smarter, but I mean, you can still invest in a shit company and not get anything out of it. So at the end of the day, you're not guaranteed anything. Even the S&P 500 could drop 50% uh, in a trade war with China, or you never know what's going to happen. And it could correct that 50%. You sell because you think it'll go lower, then it recovers the next day. So Um, definitely watch out because the Jerome Powell meeting was a good, very, very small example of that, where the market dropped. I think it was like 2%, and everyone was freaking out. Imagine if that would have been 10%, 15%, and it had been over multiple days instead of just one day. You could have seen the market sentiment be completely different.
yeah. So we got a couple more questions here. I want to catch both of these if we can. So Rohan has a great question here about QILD. So QILD, for those who aren't familiar, that's the Nasdaq 100 covered call ETF. So to cover a few quick basics, and we can move on. ETFs, exchange traded funds, right? This is a strategy of some kind that a fund is running for you, and they charge a slight management fee. And for that, you get the ability to buy into this thing and experience the benefits of something that tracks that strategy. So often these strategies are very simple things like leveraged bets on certain items, or they are baskets of stocks put together, or they're, ownership interest in a bunch of different natural resource companies or things like that. This is a slightly different category than this is a covered call ETF. What that means is that they are buying shares in the Nasdaq 100 here, but you can imagine they just buy shares in Google or something, and then they sell calls out of the money on those shares, just like you would in your own portfolio. And this gives you the ability then to basically latch onto the growth of that stock while also protecting your downside a little bit because calls are being sold the whole way up, right? This is often a way to supplement your income from the growth of a stock that you've already got. If you buy a bunch of um, if you buy a bunch of calls in sort of a leap zone, and then they blow up and you want to take profit without removing your calls, another option is you might buy them to cover them that way. This ETF does that for you. Basically, it's managing a covered call portfolio where they're getting income from the covered calls while they're also holding the stock. And it gives you, it gives you some protection, but it also like gives you the benefit of this strategy. Now, for that, they charge an extremely high management fee, much higher than most ETFs. I was looking here to see if I could find the management fee of QILD right off. Um,
Guarantee, let's see.
Yeah, expense ratio 6.1, management fee 0.6. Right. So this is it's not exorbitant, but you'll find that there are many lower options, right? And you pay extra because this is a more intensive task for them to manage, and you are still exposed to a lot of the volatility to the underlying stock. You have to decide for yourself if this is something you're willing to pay extra to have managed. It's a great strategy. It often succeeds for people. It's not. There's nothing wrong with it. If you like the way it performs and you like the structure of the thing, then maybe it's for you. Um, it really depends on who you are. I don't think one of the interesting things is like very few ETFs are intended to like. I don't think a person builds an ETF trying to make it bad or because it's a lousy strategy. Um,
Except for
Rohan,
Misty.
if you um, Rohan, what is alternative for QILD? The alternative would be you could try and do it yourself, right? You could try and assemble something similar by selling covered calls yourself. I wouldn't. I actually think QILD for what it gives you is kind of a bargain in this space, but you know, it's not the only option. And make sure that when you do the math on it, you simulate a couple outcomes. You're like, if it goes up this much, what is that actually? If the underlying goes up this much, what's that actually going to do? If I held it out, the underlying outright versus I held this thing, ask yourself those questions, try and compute that stuff. Sometime I'll come on and I'll come on with visualization tools and stuff like that, and we'll talk through examples like that in more detail. I've been trying to figure out how to do that better. Um, yeah, the other one that we had was Katsuha asked, "What does screening mean?" Screening, when people are talking about screening generally, there's two kinds of screening. One is if I'm talking about, I'm screening that out, I'm ignoring this thing, whatever it is. I'm talking about usually that I see something cross my radar as interesting and I pull it up and I start going over the financials and I go, no, not for me, right? It's just triaging the stock. The other side of this is broader search, right? There are screener tools in almost every brokerage, and they're also in other products like TradingView has them, Unusual Whales has one of them, etc. There are tools that you can use to perform very sophisticated searches that say, show me all the stocks that are within this band in terms of market cap that also had these events happen to them in the last year. Um, incredibly, incredibly useful because what it helps you spot are situations where something has happened that might have snapped a stock into inefficiency compared to the rest of the market, right? Uh, Maybe you have, maybe you have a strategy. This is actually very similar to the strategy that I've looked at long term. Is like I have a list of stocks that I watch, and I look at an indicator called RSI, which is basically an indicator that shows you is it unusually popular or unusually unpopular. If it's unusually popular, people call that overbought. If it's unusually unpopular at the moment, people call that oversold. This is a vast simplification, whatever. I look at sort of that on two different time scales, and I ask myself, is this oversold right now because something has happened? And is the news event that caused it to be sold off so quickly something that actually matters to me? Right? Last time I was on, I talked about Target this way. Target got sold down to like 125 or 120 or something, and I bought in a bunch at that point, and it's back up to 136, 137. That was a good play, and it made a good amount of money because this sort of strategy where I was using a strength indicator, then I was asking how do I understand what that actually means for what's happening was working well for me. That's an example of using a screener to your advantage. I had a list of stocks I trusted. I put them in the screener, and it would help sort of surface for me things that were going on related to them that I could then become an expert in and then decide to act on. Yeah.
Yeah, I've seen a kind of fad online where people are trying to rely on bots to screen for them and to pay for services that have those bots, and it's so easy to do yourself that's kind of just a novelty, as well as like you're then paying someone to feed you stocks that they recommend to you. So I just don't I don't agree with that personally, but that's also something going on is using AI to try
Hmm.
to get an advantage.
Yeah, I've got lots of thoughts on that and lots of things I want to try still. For full transparency, I work in big tech and I work in um, in an AI related subfield. Um, I do not use my work for my personal life in this way, right? But that absolutely, I've thought about like strategies that you could use that combine, language models or other tools. Sometime maybe I'll come back and discuss something I've been prototyping out for that. Um, but yeah, I think the thing is that often you can pay for services that will have very sophisticated algorithms that will help you spot this stuff. Um, the thing is, you have no alpha there because everyone else can pay for that same service. And the other thing is, you don't know what you're looking at. You don't know what you're looking for. You need to understand how the thing works and what it's giving you in order to be able to use it effectively. Um, there's this thing that happens in almost every sort of skill where at the beginning you start out and then you learn a little bit and suddenly you think you're pretty good at it and you think there's this entire universe of stuff that's like all these fancy terms and tools and things and you've got it all over the place. And in stocks that means that you throw up a chart and you're drawing all these things and it's like, it's an inverse triple dip bow tie or whatever. That's BS. And
And
what
then
you
you lose
realize over
sixteen
time is
thousand
kind of
dollars
weird.
on zero DTE choo calls
Right,
because you
right.
think you're
So
better than
like
the market.
this stuff happens and you start like getting really intense into all these incredibly complicated technical concepts and some of it's useful, but like what you wind up doing, and this is the same thing that anyone will tell you in any other industry, is that once you've learned all this stuff, once you've sort of digested it and you've decided for yourself what's good and what's bad and what's BS and what doesn't help you, then it's more of an art where you find you back to how you started out, which is actually, I kind of look around at all the different things happening in the market, how things are moving, and I vibe it out after doing some investigation, and I decide that this is the right move or the wrong move. And you're using those other things you learned as tools to make educated guesses instead of where you started, which is just random luck. Um, uh, this is the same thing, you talk to a virtuosic pianist
It's
or
an
something, and they're like,
educated
oh yeah, I feel it
wish.
out, right?
It's an educated
You
wish, not
educated
a
wishes.
guess.
That's pretty
It's an
good.
educated wish.
Yeah. So so yeah. I think you learn the tools, learn the techniques, learn all this stuff. Don't pay anyone for courses. Don't pay anyone for courses. But learn tools, techniques, get good with them, get fluent with them. You don't need everything. You need a couple things, and you'll figure out what they are for you and how they work well. Another great question here about sort of passive investing with robo advisories and stuff like that. That's an option. I mean, often it behaves very similarly to ETFs, so maybe you can just use ETFs. People vary. I have an amount in a robo advisory, and I have kept it there for a long time. And the only reason I do it actually is because I don't think about what's happening in it, and I like that. And I'm not gonna a cats it out just because I want to have a better say or I don't agree with the management fee. The entire point of that money for me is that I don't touch it. And it really underperformed the market for several years in a major distressing way. And now it's overperforming the market again. And it's just like, fine,
It's
fine.
kind of what
At
happened
least it's
with
a different
Bitcoin as
strategy than mine.
well. You know what I mean? Like that's why diversification's so good because like right now Bitcoin's overperforming the market. You know, it's a new year now, so who knows, but last year it overperformed the market, but next year it could ghost town in Q3, you never know. So that's why diversification's important and you just let your diverse assets sit. That's the important part, right? Like I was talking about like graphene. I don't want to jump into specifics, but there's specific companies and sectors that probably won't pop off until like 2030 that I'm just sitting on because they're so cheap, right? So, um, and some of those are ETFs as well. So on industries that are kind of laying dormant right now because of, like you're saying, there's different market opportunities available. But during significant market downturn or during any kind of catalyst event, those could overperform some of the other assets that, like if the stock market crashed because all the EPSs are insane right now, over 112 EPS, um, in big tech. Say big tech had some kind of giant fallout because like an EMP blew up in the stratosphere or something. Uh, some of these other assets would then be the go-to. Uh, I'm not going to say specific assets just to avoid being weird about it, but like broad stuff like gold or silver even. Um, You know what I mean? So kind of getting off track here, but definitely diverse assets over time will be a good safety.
Yeah, I think it's worth calling out, though. Like, so we talked a little bit about penny stocks. One of the biggest sectors for penny stocks is mining and minerals. Um, and I think this is a great thing to think about very critically as you're doing this stuff. Is you're sort of in a double challenging situation there, right? Because all of the things I talked about with penny stocks, those still apply. Plus, you are in a minerals industry where you need to think about what's going to happen to the value of the mineral over time. So, um, just keep this stuff in mind as you're looking at all this stuff. Now, that means, of course, that these penny stocks also could have potentially major moves, right? But
That's why
the
you diversify. You don't want to
high
all in
risk
on a
move,
penny stock.
right? Well, I frankly I go zero in on penny stocks generally.
Oh, well,
There are
there's
very
that
few that
too.
I've
Yeah.
had
I
high
mean,
confidence in. There have been a couple. There have been a couple, and I've been very happy with my decisions on the ones
I
that
was
I
pretty
chose to
happy
go in
with
on
Cooler.
mostly. But
I sold way too early, but also that $5 valuation just didn't make sense to me. But I said $3 end of year, and that came true. So there's that. My target was met. But I bought Cooler when it was about 78 cents, I believe, and
yeah.
I sold it right below $3 because $3 was my target, and I didn't want it to dip before. Like I just lack of confidence. The CEO was great. I loved that conversation that Elway had with him, but I wasn't sold on the quantum bit of the business, which was why it went up to $5, is because of that quantum hype all of a
I
sudden.
mean, I think it went up to $5 because people posted their gains on Reddit.
Oh, well, there's that too, right? But
Yeah,
there,
I mean, and that's the scary thing about all of this, right?
but
And
here's
this
the
is,
thing with this company, though. It was getting the eVTOL hype. It was getting the quantum hype. It was getting the Bitcoin hype. Like, it was just getting a lot of hype because it's in all these different emerging sectors, slash possibly like overhyped status, especially with the quantum, etc. So it was pretty insane to watch it to run up. Uh, yeah, that
so
was wild.
okay, so let's talk about a couple of things here. Let's talk about okay. So we have a couple people asking about OPTT, so that's a big hype stock right now. Ocean Power Tech, I believe it is.
They dipped at
Tiny,
earnings.
tiny market cap on that. I haven't gone deep on that company, but I can say I'm mostly steering clear of it. I mean, I watch it move every day, and of course, you get a little FOMO watching this thing move 80% in a day. But I'm not personally involved in that one because I don't think I understand this movement. It reminds me a lot of Faraday. Remember, Faraday Futures was moving a lot like this about 6 months ago. Um, I don't know. I don't know. So the thing to keep in mind with a lot of these is the smaller this thing gets, the more like the movement is actually because people are buying and selling because of recommendations on social
That's
media.
what's going on. So to kind of jump into it, obviously their partnership with RCAT is kind of the driving factor because RCAT's went up so high. Um, RCAT's partnered with Paladine, OPTT, and a couple other companies, and these are all the companies that are doing this kind of movement. So it's pretty much just people trying to ride partnership hype out of RCAT. If you look at the earnings, OPTT went way back down to the pre-buying levels. Like everyone sold off because obviously their earnings didn't turn up. Their RCAP partnership because it was not in that quarter. So obviously the earnings underperformed with all these investors that don't know how earnings calls work or quarterly reports. So basically the company sold off and now it's ramping up again. Back, I think it'll trade at about $1, if it hasn't already, just because of, like you were saying, buying and selling and people just wanting a piece of it because they
Right.
see all these gains that people have
So
been
this is
making.
one of those categories where like, you know, um uh like when you start talking about companies that are getting big boosts for speculative reasons that right their revenue numbers even from new contracts can't necessarily account for things like that. um and then the companies that are partnered with those companies are also getting boosts. Uh, this uh, this does not vibe of true like high value plays to me. This vibes of like fan fiction based investing.
Yeah,
Right,
that's kind
where
of what
people
it
are bullish on
is.
one company and because of that they invent narratives related to other companies. And we used to see this with like with like the GameStop Ryan Cohen stuff and things like that, is that people are making up all sorts of insane stories and it moves the market for the other stock.
Well,
And it's like, no,
OPTT's
no.
current run is because I believe RCAP paid for a partnership with Palantir. So now everyone's like OPTT Palantir. So it's definitely like a kind of
Right,
hype man.
this is all BS. This is not a price that's driven by credible sentiment. This is a price that's driven by speculative hype and
I
retail
could be
speculative
wrong. They
hype.
might have had some kind of naval breakthrough where their data is worth so much more money now that all these companies want to acquire them. But is that the most likely scenario here? Most likely not.
So, this is the thing that we see a lot right now, and I want to before we sort of start trailing off a little bit here, because I think we're reaching it. We're reaching probably a good pausing point. I want to talk about one more thing here, which is that like think very hard about like it's actually fine to bet on something getting more hyped up. I think that's fine and it's reasonable and you can do that sometimes. But when you're doing this sort of greater fool investing, where you're buying something to sell it to someone, I'll say Kyle Zachary. I had some fun doing that with AISP, where I looked at it and I was like, "This is a nothing burger company, in my opinion. In my opinion, I'm not an analyst. I'm not, whatever. I try not to analyze stocks in public for a reason. Um, it's tiny, tiny thing that seems like it's going to blow up, though. I think I can get in on this and then double a tiny play and then get out. And I did, and that was fun. I had fun. A couple $100, nothing more. Had much larger portfolio than that. I didn't want to do anymore because I didn't trust this. That's fun. You got to think very carefully when you're making those greater fool plays. Are you like participating in? There's this term that sort of got popularized when it was describing multi-level marketing, and then it became a little popular again during the first big crypto boom a couple of years ago, uh, where people call things Ponzi-nomics, which isn't to say it's a Ponzi scheme, right? It's just it's shaped like a Ponzi scheme. Right? It's not that I am taking Peter's money and giving it to Paul. It's that I'm waiting for Peter to buy my stock. Right? And I am relying on my gain coming from the fact that Peter's willing to pay more, and then whoever's after Peter has to be willing to pay more, and whoever's after that has to be willing to pay more. And this entire thing's sustained by the fact that each time we do this, we're each posting our 100% gains on Reddit. This is
Yeah,
unsustainable. It's going to fall over eventually. It usually falls over when you have your first down day by 10%. So, you know, think hard about what you're doing here with these penny stocks and these small things and these micro caps that you can basically pump with a post on Reddit, because there's nothing wrong with talking in your book, but don't lie. That's illegal. And B, it's it's not real. Like there's no underlying thing here that's going to support you when things go wrong. You can't fall back on the intrinsic value of the thing if there's no intrinsic value. And that's the thing I want people to make sure they think about really hard is, if there's not intrinsic value, what does that mean?
definitely. And like you tying it back to kind of towards the beginning of this, an EPS that's overvalued, like is fine, but you need to, I mean, fine, whatever. But in the current market, right? But you want to compare it to the industry. So say Google's trading at 100 EPS, Microsoft's trading at 98 EPS. A company with a similar EPS is fine, but then you find a company that's trading at an EPS of like 298 or something. That's something to kind of look at and be like, okay, is this company really like outperforming Google and Microsoft? So that's kind of where you need to start hitting the brakes.
Yeah, I'm not going to tell anybody to not buy Tesla or whatever, right? But like, this is what speculation looks like. What happened to Tesla right now? What happened to lots of things? It doesn't mean that it's
It'll
not
probably
the
go
the
back
right
up,
price,
but
right? Exactly. It just means a lot's happening right now, and you may not be able to fall back on the intrinsic value of the business being $400 a share. So, yeah, uh, yeah. Um, and I think probably it's about time for me to say bye. But I don't know. Maybe Tyler's gonna stick around a little longer. Hit me up on After Hour if you want to chat about any of this stuff more. Uh, One other plea, minor plea. Um, I don't play any funny games with tips. I don't do the whole tip thing that people are doing where they're like, tipping each other to pass tips around or anything. So like, if you find this kind of conversation useful, if you find this stuff useful, the only way that I'll get surfaced is if you actually tip. Um, I just try to post high quality, content and boost high quality content. So, you know, tip me if you feel like it's appropriate. And yeah, let me know if this is useful. DM me on Discord, whatever. I'll be around for a while.
Okay. Well, I appreciate you coming on today, and of course, you're a really intelligent trader, so as well as investor. So I appreciate you coming on today, and I look forward to having you back on here shortly.
Yeah,
Appreciate you.
always have a lot of fun. All right, see you soon. Oh, yeah. Yeah, see you soon.
Bye for now. And then for everybody that's still watching, I appreciate you for jumping in. I also do not do this tipping culture. I it's okay to tip me, but obviously I just don't want to be tied up in any after hours scams. Like I don't want people to look at it and be like, "Oh, he's begging for tips. He just wants whatever." Um, that's not my intent at all. Good traders, good investors don't need to beg you for money, and that will have money tied to it eventually. So I'd rather set good habits now and avoid that entirely. So I really do appreciate everyone for tuning in and listening to my voice at this point, probably for an hour if not longer. So that was retentive. I will at him on After Hour in a post right now so that you guys can, as well as with the link to the recorded version of this in case you missed part of it or want to share it with a friend or After Hours buddy. So I do appreciate that. And goodbye for now. Actually, no, I will check the comments real quick. You know what? Let me back it up real quick. Let me make sure there's not anyone trying to say any last moment goodbyes, um, or anything important. Christopher, thank you, man. You rock. You rock. Everybody, I do see all of your comments saying thank you, and as well as Nathan from After Hour saying he's retentive. I will be making a post for that. Um, and refreshing to hear from someone who clearly is thinking straight. Yeah, definitely. You guys rock. After Hours is a great community. Obviously, a lot more volume has been picking up on there. There's a lot more people involved. So you're gonna have people pumping penny stocks. You're gonna have a few scammers. And what's important is the transparency of people like me and people like you calling out. Um, and instead of seeing like they're getting tipped a lot of money, they get 10,000 followers and just being like, this person is a scammer, but I want in on his hype, so I'm gonna be a hype man. Don't do that. There's a couple people I don't associate with on After Hour for a reason, um, and that's just due to them not having good practices, charging people for advice, etc. Um, I, I, I mean, I'm not gonna lie, I would take a donation, but you know what I mean. That's not the number one goal here. The tip feature, like it would be nice to get an Apple Vision Pro or whatever, but I'm not going to go asking people to send me tips. Number one, because it kind of dilutes your character. But other than that, I don't think there's anything else I need to go over. And I appreciate you guys for watching, and I will see you in the next video. Thank you guys.